Right, everyone, let's have a look at an SQE2 mock exam. And what we're going to do today is a case and matter analysis exam in business law. Let's start off by talking through the CMA assessment. So, what we need to do to score maximum marks in the CMA, what the SRA is looking for, how we can structure it, what are the key things that we need to get right. And then we will practice the mock itself. So by way of short overview, because I'm sure you guys are already familiar with how the CMA works, this language is taken from the SQE2 assessment specification. As it says here, you'll be given a case study with documents. You'll be asked to produce a written report to a partner and give a legal analysis of that case, providing client-focused advice. May include negotiation. You've got 60 minutes to do it. And you'll be marked on skills, law, and remember, ethics as well. When it comes to the skills, you're required to identify relevant facts, provide that client-focused advice, which means going beyond legal advice and providing that practical client advice. Of course, your structure and language must be appropriate as well and clear. And then you're expected to apply the law correctly and comprehensively. Now, the technique that we always drill at Devil's Advocate when it comes to doing our SQE2 mocks is the IRAC technique. And the IRAC technique means that you read through your brief carefully. So read through the brief twice, I would say, when you're in the exam. The first time to get familiar with the facts. The second time to really drill down on the details. And the first step of IRAC is issue. When you've read those facts, break it down into the tasks that you need to complete. So what is the partner asking you to do in your CMA? And in respect of each task, think, okay, what's the underlying legal issue that I need to solve? You know that in your SQE2, you are going to have to solve legal issues. This is a solicitor-based qualifying exam after all. So there will be legal issues to solve in respect of the client's demands. Now, that legal issue means identifying where you are in the syllabus. So in respect of business law, it might be identifying the fact that the underlying legal issue is, can the company make this decision in accordance with its articles of association? It might be, what are the conflict of interest rules that apply here in respect of the director decision making? It might be identifying that you have a substantial property transaction, that you have a minority shareholder dispute relating to an unfair prejudice claim. Whatever it is, the issue part is identifying where you are in the syllabus. And that then leads you to the rule part, which is recalling the relevant law. So, for example, if we were dealing with an SPT, it would be recalling the requirements to approve a substantial property transaction. So essentially requiring that ordinary resolution of the shareholders. If we were dealing with the incorporation of a company, what are the requirements when setting up a company? So the requirements when filling in that form INO1, and so on. In terms of the rule part of IRAC, the one thing that I would just bear in mind is that in the SQE2, you only have limited time, point number one. Point number two, the SRA is looking for correct and comprehensive application of the law, but what they're not looking for is essays. When we're stating our law, we're in that rule part, we want to keep our law relevant, concise, yes, detailed, but not a full essay. And that explanation of the law is a skill in and of itself, and it's what we practice often in our mocks. The next part of IRAC, application, that means using the law to answer the client's problem, setting the law against the facts. Do we have on the facts a substantial property transaction? Do we have the incorporation of a company as required by the client? What are the requirements for the client In other words, what details will they need to fill in their form IN01? So, for example, if we've been told that the client wants bespoke articles, they'll need to tick that box and then upload those bespoke articles. So simply taking that law that you've stated and then using it to answer the client's problem, application of the law to the facts. But then where IRAC really comes into itself is the final part, the conclusion part. I've put in red and underline that the SRA wants you to go a step further in the SQE2, and this is really where the candidate will score maximum marks. And that step further is to provide practical advice. And what that means is not just giving a legal analysis, but showing what that legal analysis means for the client. And it's what I call the because factor. Because the law means X, then the client will need to do Y. So because we have a substantial property transaction on the facts, having applied the law, it means that we will need an ordinary resolution of the shareholders. Because the minority shareholder has been prejudiced against unfairly, they have a cause of action under an unfair prejudice claim. So it is basically answering the actual question, and it means really going back to what was in your brief, checking what the part has instructed in respect of the client's requirements, and just making sure that you answer that, and if possible, you provide the practical implication of that. Go that one step further and just think, what does it mean for the client? And that's your conclusion part of your IRAC analysis. Now, what that means practically for the purposes of our CMA is that when we're in the exam, we want to read through that brief carefully, as I said. So read through it once to settle yourself in. Go back over it. Make sure you have a really good understanding of the facts. And identify the tasks that the partner wants you to complete. But the next step is then forming our plan. And we want to form our plan on the basis of our IRAC analysis. So that means taking each of the tasks, and for each one, the header identifies the legal issue, and you could also do a short introductory line stating what the underlying legal issue is. So in other words, pointing the partner to the relevant legal problem, and for our purposes in the exam, the examiner. Then stating the law. So the next paragraph will simply state the relevant law, the relevant legal rules for that problem. So for example, the requirements for a substantial property transaction. Application, as we mentioned, the next paragraph will apply the law to the facts. And just as a little hint or a little piece of advice, use the client's name or the company name, numbers, figures, show the examiner, in other words, that you are applying the law to the facts. And then the final paragraph can deal with the practical problem, the because factor, what it means for our client as a next step. So that's a way of structuring a CMA. It keeps you anchored in the problem question. It ensures that you answer the problem, but also that you score each of those marks in skills and law. And then generally, just a few other points to make. Remember to watch out for ethical problems. And I would deal with ethical problems separately. So in other words, have its own IRAC structure. For example, the issue here is whether we can act for both clients, and then the rule in respect of acting for two or more clients under the Code of Conduct. Application, do any of those exceptions apply? And then conclusion, can we act for the two or more clients? So make sure that you identify those ethical problems, deal with them separately. And then the other point just to make is taking a step back just briefly. The writing assessment, part of your SQE2 skills assessments, that's really more of an external work product. And what I mean by that is the writing assessment is sent to usually a third party. It might be that you're writing internally within a firm, but usually it's sent to a third party like a client or a counterparty in a negotiation. And what that means is the tone of your writing solution, your email or letter, in other words, will be different to what it is in a CMA, given that the CMA is given to a partner. And the writing assessment, you only have 30 minutes, whereas with CMA, you have 60 minutes. Now, all I'm saying here is that the CMA, 60 minutes long, is a more complicated legal analysis. You can go into detail. You can use more technical language. You're addressing the partner. You will have more legal issues to deal with and more documentation to handle as well. So just bear that in mind, that difference between the CMA and the writing, and you'll want to make sure that you approach those two assessments differently. So I've put down that structure as to how we deal with it in this diagram as well. Briefly, opening paragraph, make sure we get that right. It just gives a really good tone to our CMA. And a good way to deal with the opening paragraph is to give a brief background on the instructions that the partner has given you. Direct how you're going to structure your analysis, so the issues that you're going to be dealing with. In other words, showing the examiner the legal issues that you're going to be tackling. And then you could also include a sentence or paragraph, very briefly, that directs your analysis. So in other words, concludes the answer. That may not be applicable all the time, but it might be in an assessment you can actually give the answer in a sentence, and then you're showing in your analysis how you reached that answer. Otherwise, a header for each of the legal issues, and within that, paragraph or rule, application, and then potentially conclusion. And then dealing with any ethical issues in a separate part of the answer. And just note negotiation points as well may be applicable, and that will usually weave itself through the assessment. Let's have a look at the mock. Now, before we dive in, just as a warning point, this is a hard mock. Okay, so bear in mind, this is a difficult mock, and I've chosen it deliberately to be difficult, or written it to be difficult, because I believe in train hard, fight easy. Get the hard stuff right, and in your exam, it will be a breeze. So let's briefly go through the facts. We'll then go back over it, pick out the key points, and then we're going to dissect the mock, identifying each of the legal issues. We'll go through the law for those legal issues, and then we'll have a look at the plan and briefly the solution at the end as well. So we act for X Limited, a private company limited by shares, incorporated in 2021. The company has 2 directors, Mr. Evans and Ms. Patel, and 5 shareholders, none of whom are directors. It uses the model articles. The company qualifies as a small company under Section 382 of the Companies Act 2006. The directors have asked us to advise them on their accounting and tax obligations as they prepare the annual accounts for their financial year ending 31st of December 2025. Last year, they filed abridged accounts. They want to know if they can do so this year. The shareholders are happy for the directors to file any accounts they feel necessary. The company qualifies for an audit exemption. As that financial year has ended, the directors now want to declare a final dividend. The directors are particularly concerned to ensure they meet all statutory requirements under the Companies Act and avoid any personal liability. They want to know they can lawfully declare a dividend. I attached the company's profit and loss account and balance sheet, which are in draft. The directors asked a local auditor to prepare these, but they don't know what they mean, why they have to have them, and what to do with them. You should interpret the financial statements for the directors, explain what the profit and loss account and balance sheet are and what the results mean for the company. Calculate the corporation tax liability, assuming a flat rate of 20%, and advise the directors on their obligations under the Companies Act regarding accounts, records, reports, and filing, the impact of being a small company in respect of audit, filing exemptions, and the directors' report, whether they can lawfully declare a dividend, and any risks or liabilities. And then we've got additional information for our tax calculation. So, as it says here, we've got a trading profit of £120,000. We've got a chargeable gain of £10,000. We've got a capital allowance of £5,000 and a loss from the previous year of £15,000. We've actually only got 2 attached documents here. So one of them is a profit and loss account, and the other is a balance sheet. And as we've seen, part of our answer is going to be analysing these 2 documents. So let's go back over this brief and start to break it down. As you can see, it is slightly complicated, but if we break it down, it does get easier. So what are we dealing with here? We're dealing with advising the directors through our CMA address to the partner on their accounting obligations under the Companies Act as a small company. We're also advising them on the rules in respect of dividends, including the process. And we're dealing with corporation tax. In addition to that, less of a legal issue, but we need to analyse the profit and loss account and balance sheet. So let's start with this profit and loss account and balance sheet briefly, because as I say, less of a legal point. And for the purposes of the SQE, we don't need to know this to any kind of accounting standard. But as newly qualified solicitors, we are expected to have a basic understanding of how these accounts work. So very basically, profit and loss account shows the profit and loss that the company has made during the financial year, during the course of that accounting period. So at the end of the profit and loss account, you will see whether the company has made a profit or whether they have made a loss. This is in draft form, as we were told in the brief, so it's not in final form, but basically it's showing turnover, less cost, giving us our gross profit, further cost, that's expenses and wages, again, giving us an operating profit. We've got other income, giving us a profit before taxation. And remember, we need to calculate the corporation tax to give us a final profit figure. So profit and loss account simply showing the amount that the company's made less the amount that it costs to make that stuff, giving us a profit at the end. The balance sheet is a snapshot of the company's financial position at a given time. So rather than showing profit and loss, it will show the assets that the company has. So assets like, as it says here, equipment, and then stock, debtors, cash in bank, and then the liabilities, if you like, taken away from those assets. So the amount that the company owes on a long-term basis, but also on a short-term basis. So that includes your trade creditors, so your suppliers, for example, a bank loan. And it balances the top half with the bottom half essentially showing the capital. So in other words, the asset position will balance with the capital position and essentially will show as either a positive position if your assets are greater than your liabilities, or vice versa, then a negative position. And that description is absolutely fine. I don't think we need to go into any more detail than that. Of course, you may have some more insights, absolutely fine. All I would say is we've got a lot more to cover, so just bear that in mind as we look through the rest of this mock. So we can deal with that relatively briefly. Let's dive into the actual legal problems then. So the first is in respect of the accounting requirements for this company. Now let's pick out some of the key facts here. We've got 2 directors of a private company that uses the model articles. The company qualifies as a small company. So remember those regimes, the accounting regimes and filing regimes, depending on the size of the company. So at the smallest end, you've got the micro entities, then you've got small, medium and large, and separately you've got public companies. You do need to be aware of the thresholds for each of these. It's a bit of a pain, but I do recommend learning those. But in particular, you should have an understanding of the difference in the accounting and filing requirements of micro entities, small companies, and then going on to medium, large, and public. And basically, if we were to distill it down, as you might expect, micro entities and small companies have relatively basic accounting and filing requirements. And then medium and large and public companies essentially have full accounting requirements, including an audit requirement. Whereas micro entities and small companies are exempt from audit on the whole. So that's another issue just to bear in mind when we're looking at the facts of this assessment. We've been told they want to file a bridged accounts, and they did so last year, and it looks like the shareholders are happy for them to do so. So we need to bear that in mind and deal with what they mean by abridged accounts. We've been told about the audit exemption. Fine. So those are the key facts in respect of the accounting stuff, and we'll have a look at the law on that next. Just briefly on a dividend, we've got to deal with that corporation tax point. That's going to be important for us to understand whether a dividend can be paid, because essentially, if we've got money left after tax, that can be distributed, as we will see. So we should do the corporation tax question before we deal with the dividend. And when it comes to the dividend, that's really two subtopics. One of them is the process to make a dividend. The directors want to understand how to do this dividend, but also the law on dividends. Can they lawfully declare a dividend? And as I said, we'll need to deal with the corporation tax calculation first, and then we can advise on the lawfulness of the dividend. So let's start with company accounts. Before I do so, a common question, is this actually in the assessment specification? Unfortunately, yes. So the assessment specification requires you to know about director obligations when it comes to the accounts and financial records. Again, you don't need to have an accountant's mind in terms of being able to understand the full requirements and how to read those accounts, etc. But we need to have a good, solid understanding of those accounting requirements. And that's really what we're covering today. So let's dive into the law then on these accounting requirements. And the starting point is under section 386, the duty to keep accounting records. Now, just briefly, let me go back. Remember that I said we've got to understand the obligations for the directors. So when we're looking through this law, try and keep an eye out for these director obligations. So section 386, duty to keep accounting records. Every company must keep accounting records, and accounting records basically need to show the company's transactions, their financial position. So day-to-day sums of money received and expended. And then duty to keep accounting records under section 387. If a company fails to comply with section 386, then there's an offence committed by every officer who's in default. So we have potential liability there for our directors. Now, what does this mean, the accounting records? The accounting records is the first step for your preparation of accounts. What section 386 requires is that a company keeps a list of all its transactions, usually on like a data set. And from that data, it can then form its accounts. So our first step is we need to make sure, and presumably we've got this because we've got these draft accounts, that the directors are keeping these adequate accounting records. So that's our first step. From those accounting records, as I said, we can form our accounts. Why do we need to form the accounts? Section 394, the directors of every company must prepare accounts for the company for each of its financial years. Those accounts are referred to as the company's individual accounts. So we have an obligation, the directors have an obligation, to prepare company accounts every year. Again, another director obligation. Section 393 also requires that the directors approve these accounts, but they can only do so if they are satisfied that the accounts give a true and fair view of the financial position of the company. So we need to make sure that we make it clear to the directors that they can only sign off on these accounts. They're in draft form, remember, but they should only sign off on them if they're satisfied that they give a true and fair view. So we know we need to keep adequate accounting records. We know that from those accounting records we can prepare our accounts. We know that those accounts must give a true and fair view. What actually do we mean by accounts, though? So, section 395, accounts are made in accordance either with the UK framework, so that's UK GAAP or the company's house accounts, or in accordance with the IFRS. Usually, and particularly for small companies, it will be the UK regime, and that's section 396. And that requires that the accounts have a balance sheet and a profit and loss, which ours do. The accounts must, in the case of a balance sheet, give a true and fair view of the state of affairs of the company, and in the case of a profit and loss account, give a true and fair view of the profit or loss. So again, that true and fair view wording. If you just look down slightly, it says in the case of individual accounts of a micro entity, that true and fair view is presumed. But we've got a small company, so we need to make sure that the directors are fully satisfied that we have that true and fair view of the accounts. So, just by way of recap, directors must keep adequate accounting records. From those, they prepare the company accounts, which they're required to do so under the Companies Act. Those company accounts must comprise of your balance sheet and profit and loss, which we've got in draft form. Must give a true and fair view signed off by the directors. And again, we've got that here. So 4141, a company's annual accounts must be approved by the board and signed by a board member. Signature must be on the company's balance sheet. Small point to make in subsection 3, that they need to have notes if they're a small company. So if accounts are prepared in accordance with the small companies regime, the balance sheet must contain in a prominent position, in the case of individual accounts and microentities, a statement to that effect, or otherwise a statement that they've been prepared in accordance with the provisions applicable to companies subject to the small companies regime. So in other words, the balance sheet needs to have some notes to it if it's a small company. Again, we've got another offence here. If the annual accounts are approved that do not comply with the requirements of this Act, every director basically commits an offence. So again, we need to make the directors aware of this potential criminal liability. Section 415 requires that if you are a small company, you prepare a director's report. And again, look at subsection 4, potential offence. So in the case of a failure to comply with the requirement to prepare a report, an offence is committed by a director. Section 423, you must send a copy of your accounts to the shareholders. And then section 441, duty to file the accounts. If you're a small company, you only need to file your balance sheet. So you prepare a director's report, you prepare a profit and loss account, but they don't need to be filed. They can be, but they don't need to be. Similarly, microentity only needs to file a balance sheet, no need to file their profit and loss. That is changing from 2028, but for now, those are the rules. Do so within the period for filing your accounts. So for a private company, 9 months after the end of the accounting reference period. And again, an offence if you fail to comply with those filing requirements. Now, the final point just to mention are these abridged accounts, which we saw in the brief, but what does it actually mean? Again, at the moment, if you're a micro entity or a small company, you can prepare what are called abridged accounts. And that basically means simplified accounts. You need the consent of the shareholders, but you can abridge your balance sheet and your profit and loss account. Also worth mentioning that your director's report for a small company can be simplified, and you can file that abridged balance sheet at Companies House. So abridged accounts basically just means simplified accounts for the purposes of a micro entity or small company. Now, that seemed like a lot of law, but actually you can distill that down into basically 4 or 5 sentences. And then importantly, we don't need to know the section numbers of the Companies Act. The only reason why I've gone through all of that is for your full context of information, but you don't need to know it for the exam. Really important to stress that. So if we were to distill all of that down, we can say that you've got to prepare those adequate accounting records. If you fail to do so, there's a potential offence. Those adequate accounting records form the basis of your company accounts, which must be prepared each year, must give a true and fair view in order for you to sign them off. And again, if you fail to prepare those accounts, there's a potential offence there. The accounts must comprise of a balance sheet and profit and loss, small company director's report. The director's report may be filed at Companies House, profit and loss may be filed, balance sheet must be filed. Balance sheet must be signed by a director. If it's a balance sheet for a small company, must contain certain notes as required by the Act. Failure to file a director's report, by the way, also a potential offence there. The accounts can be abridged, given that the accounts were abridged for the company last year, and we've been told that the shareholders are happy for the directors to do that again, then the directors can abridge the accounts with that shareholder approval. So you can distill it down. There's some other points there that you can add in, but basically that's it. So it's not actually that scary. What we need to pick out are the obligations that the directors have in respect of these accounts and their liabilities. So that's the criminal liabilities. Also just worth mentioning, whenever we're dealing with director issues, just bear in mind those statutory duties underline all of it. So sections 171 to sections 177 of the Companies Act. Section 174, the requirement to exercise care and skill. So in other words, not to be negligent. And that can arise here. If your directors, for example, if they fail to circulate your accounts to the shareholders, if they fail to prepare the accounts properly, potential 174 liability there. So just bear that in mind. Okay, so we'll look in the plan as to how we've applied the law there. But really, it's just about stating to the partner expressly what our directors will need to do. Let's go on to the dividend point. So, in respect of dividends, remember that we've got two issues here. One is the rules on dividends, and the other is the process on dividends. Let's deal with the rules part first. So, deep dive into the law here. This is quite technical. A dividend is a form of distribution. And that means it's a form of payment to your shareholders. Another way of distributing is through a buyback of shares or a redemption of shares. Okay? Dividends are the most common way that shareholders are paid. Now, a distribution must be made out of distributable profits. A share buyback and a redemption of shares must be made, therefore, also out of distributable profits, but they can also be made out of the proceeds of a fresh issue of shares. But in respect of dividends, they must and they can only be made out of distributable profits. Now, we've got the definition of distributable profits on the slide here. So, subsection 2, a company's profits available for distribution are its accumulated realised profits, so far as not previously utilised by distribution or capitalisation, less its accumulated realised losses. Now, there is quite a lot of accountancy analysis that goes into whether something is a distributable profit or not. But basically what it means is the cash that the company has left over after payment of corporation tax. And corporation tax is payable on your total taxable profits. So that's the money that you have after all the payment of your liabilities and debts, expenses, etc. So the easiest way to see it is the money left over after corporation tax has been paid. And you can make an interim dividend based on that amount and based on the interim accounts, or a final dividend based on the company accounts, so the year-end accounts. And that's the other important point to make about dividends. They need to be made out of distributable profits, but the definition of distributable profits is with reference to the company's accounts, properly prepared. So what that means is if you're making an interim dividend, so a dividend during the financial year, you must always make it with reference to the interim accounts. So properly prepared interim accounts. And if you're making them in respect of a final dividend, then the final accounts must be consulted, the company's accounts. So we need to have distributable profits and in respect of accounts properly prepared. And section 836 is what tells us that we need justification by reference to the accounts. I've summarised it here on this slide. What happens if we get it wrong? The distribution is unlawful and void, so our dividend is unlawful and void, and we have potential liability. We have potential shareholder liability if they knew or ought to have known the facts that made it unlawful. And similarly, director liability, so the directors who authorised the dividend, they are joint and severally liable if they knew or ought to have known that it was unlawful. So, again, another liability that we need to make our directors aware of. And our analysis will essentially be one of stating, okay, do we have distributable profits? If we do, dividend can be made, but we should make the directors aware of the risks and liabilities if it's made unlawfully. Which then, of course, brings us to process. How do we make our dividend? We've been told that the company uses the model articles. We've been told that this is a final dividend. So in respect of a final dividend, the directors make the recommendation, the shareholders declare it via ordinary resolution. In respect of an interim dividend, the directors can just make that payment themselves via board resolution. So what we'll be telling the company here, given that they've got the directors here, given that they've got model articles, we need shareholder authorization by ordinary resolution. And that then brings us to the final point of the analysis, which is our corporation tax calculation. Now, in the actual structure of the CMA, I would do this before I go on to my dividends, because this will tell me whether I actually have distributable profits. So we've been told that the corporation tax rate for the purposes of this mock is 20%, and you will be given the tax rates in the SQE2. Just taking a step back as a bit of a recap on corporation tax, and I've mentioned this already, but remember, it's the tax applied to your total taxable profits. Total taxable profits being the sum of your income profits and your chargeable gains. So you've got two steps that you need to take. One is to calculate income profits, and the other is to calculate chargeable gains. Income profits is your turnover less cost, and you also apply capital allowances. So your reliefs on investments in plant and machinery. And that then gives you your income profit. And chargeable gains is essentially a CGT calculation. It is the consideration received for a disposal of asset, less cost, so initial cost, acquisition cost, that is, cost during the holding of the asset, disposal cost. So that's how it works in respect of adding those two together, add together your income profits, add together your chargeable gains, apply any losses. So you can have trading losses, you can have capital losses, rules in respect of how those work as well. So do go over those if you're unsure. And then you'll have your TTP, and the tax rate is applied to the TTP. So if we apply that here, first thing to do, calculate our income profits. We've been told that we have £120,000 in turnover and a capital allowance of £5,000. So we can simply deduct our capital allowance, 5,000 from 120,000, giving us 115,000. We were told the chargeable gains. We don't need to apply any cost of disposal or anything because we were just given the figure. So that's £10,000. You can add that, meaning it's 125,000. And then we were told that we had a trading loss being carried forward from the previous year. Trading losses can be deducted against both income profits and chargeable gains. So we can just deduct that directly against our 125. So 15,000 applied against 125, 110,000. Corporation tax of 20% of 110,000 gives us a corporation tax payable of 22,000. So we've got a corporation tax liability of 22,000. We have a profit before tax here of 110. So that gives us a profit after tax in this accounting period of 88. We also have in our balance sheet retained earnings. So that is profits brought forward from previous years. So, and I think that's 30,000 if we go back to our balance sheet. Yeah, so that's retained earnings brought forward, £30,000. That's this bit here. So we know that we have enough money to make our dividend. So we can advise the directors that they can make a lawful dividend given that we have distributable profits in accordance with the procedure under the model articles. Again, though, just bear in mind director duties, sections 171 to 177. Applicable ones here really, section 172. So to act in the best interests of the company, interests of members as a whole. So promote the success of the company with the best interests of the members of the whole in your mind. Section 174, care and skill, as I've mentioned. So when you're declaring a dividend, you should always bear in mind the overall state of the company. You should do so in a way that is responsible. We know that the company is in a positive financial position given the balance sheet, but just always bear in mind those director statutory duties, as I say, when we're doing any kind of director analysis. Good, and then these slides really are just the plan, and it's essentially everything that we've discussed, but it's the plan as I would do it in my exam before tackling my full solution. So issue the director's obligations regarding accounts. We must keep adequate accounting records. We must prepare annual accounts, make sure they give a true and fair view, must include the balance sheet and profit and loss account, may be abridged, subject to member approval, prepare a director's report, file a balance sheet within the 9 months end, send copies to members. We've got an audit exemption and the potential offences as well. And then in my plan, what I've done is a very brief application, Note that I've used the company name to show that I'm applying the law here. And my conclusion is just what it means for my directors practically. Issue 2 is the analysis of the profit and loss and balance sheet, so less of a legal analysis there, more of that practical analysis. And then issue 3, corporation tax, going through that tax calculation, and issue 4, dividend legality. What we've then got is the full solution, so a short paragraph here for our introduction. But otherwise, the full solution going through with legal issue, rule, application, conclusion. Same structure here. Corporation tax, of course, slightly different because it's just a mathematical calculation there. But when it comes to dividend, again, issue, rule, application, conclusion. But structured just as we've really discussed. And that's it. So I hope that was helpful. A full CMA, a tricky CMA. If you're unsure about the rules on company accounts, do go back over them. It could be something that they throw at you in the SQE2. Have a look at the rules on dividends. That is certainly something that can be examined. It's a very popular topic in business law cases because it is so important to understand dividends. And otherwise, a good understanding of director responsibilities as well to the company.